This is the Everything Financial Radio program. I'm your host, Dennis Tubbergen. I have the distinct pleasure of chatting today with Dr. A. Gary Shilling, who is the author of Insight and president of A. Gary Shilling and Company. His latest book is The Age of Deleveraging. I would encourage you to check that out as well. Gary, let me jump in because we're seeing some, at least spots of positive economic news here. Let's talk about the average American household for a minute. If we look at earnings and employment, are things improving in this area from your research?
We have very much a polarized economy right now. If you look at people on the top in terms of income, they are back to where they were and then some in many cases compared to the peak of business back in 2007. Stock ownership is very concentrated of people at the top, and that, of course, has been a huge benefit to them, and also their incomes in general. These are people who can compete in today's global world. But if you look at the rest, then this might be somewhere three-quarters of the total population, somewhere in that vicinity. A lot of these people are, as far as they're concerned, and in reality, they still are in recession. Real, meaning inflation-adjusted wages, have been consistently declining. Median incomes in this country have been declining after you adjust for inflation. For most people, their biggest asset is not their stock portfolio, but their owner-occupied house. About 2/3 of households own their own abodes, and house prices have revived somewhat, but from a very, very low level. I mean, they were down from the peak about a third. Now they're down 28%. They're still down quite a bit. They have had some revival, but that has not been enough for the average individual to push up their net worth and make them feel that much wealthier. So both from an income and an asset standpoint, a lot of people are still obviously in pretty tough straits.
You know, Gary, let's talk too about household debt levels, because certainly that is weighing on the economy as well. Where are debt levels now in the private sector compared to a few years ago? Are things improving in that area?
Well, they are. If you look at the total debt in relation to after-tax income, and this is the way, you always need a denominator there, because the numbers themselves are not going to tell you much. Everything tends to get bigger over time, so you need a standard. You need an after-tax income is a common one that we use, and a lot of other people do too. And in relation to that, total debt, and now this is debt from mortgages, it's home equity loans, it's student loans, auto loans, credit card loans, all these things. You add them all up, divide by this after-tax income, it got up to 130%. Now it's down now to 91%, but it's still a long way from the norm of 65% is where it was when we started. On top of that, the biggest share of that decline from 131% to 91% has come through mortgage debt reductions, and it's hard to get the exact numbers on this. The data just isn't available, but at least half of that reduction is because of write-offs and losses on those mortgages. In other words, it isn't people repaying them. It's just that they defaulted and they were written off. Now you can say, well, they're out from under that debt. Yeah, but their credit scores are in pretty dire shape as a result. So I would say that if you made some kind of a judgmental correction on this whole thing, yes, debt levels are down, but they're still somewhere at least 50% higher in relation to after-tax income than they were historically.
So, Gary, do we have to get debt levels back down to this norm of 65% before we start to see more robust economic growth, in your view?
Well, I would think so, because I'm a long-term believer in reversion to norms when norms are long established, as this one was. Also, it's a question of the income side, and what we are seeing here is in this globalized world, there are a lot of people who simply do not have the skills to compete, and employers are being very cautious. They don't know what the outlook is. They're uncertain about policy in Washington. We've got political gridlock there. Don't know what they're going to do with the all the entitlement problems. These are retiring post-war babies and the Social Security and Medicare costs that are coming and increasing as we move down the road. A lot of uncertainty there, and so you don't see business rushing out to hire people. They're being very picky, waiting for people with just the right skills. And of course, you see a record number of people have been out of work for 6 months or more. And interestingly enough, if these people do get employed, the surveys show that about a third of them who've been out of work for 6 months or more, if they do get a job, it's going to be less pay than their last job. We're seeing, for example, you look in the auto industry. Auto industry is doing fine right now, where they've closed a lot of plants, and people coming in there working at $14 an hour, which is literally half what the veterans were making. This was part of the workout after the bankruptcies of Chrysler and GM. So you're seeing a lot of people who really don't have the income, they don't have the jobs, they're working for less money. So it's really a matter of debt levels, and of course it's hard for a lot of people to work down debt levels when they don't have the income.
So, Gary, in your recent newsletter, you talk about the fact that we've seen a rebound in U.S. manufacturing. In your view, is this trend going to continue? And if so, how will the employment and the wage picture that we were just talking about be affected?
Well, it's a fascinating picture, and a lot is being made of the return of manufacturing to this country. And we have a separate article in our August newsletter, or September, looking at that in detail. And there's no question that manufacturing activity is reviving. It's not running through the roof. But the main point is that accompanying that is a turn to long-term high trend growth in output per employee, output per worker. Matter of fact, we just got revisions that are out today on productivity, and the numbers revised up tremendously. And what is this telling you? Well, it's telling you that manufacturing is coming back here, but it's not the labor-intensive, low-skill type of manufacturing. It's not, manufacturing on a mass basis, shoes and textiles and things like that. It's this additive manufacturing, a very robotic-intensive, computer control, where they're actually making substances by building up layers on a completely digital controlled basis, and it's very, very sophisticated manufacturing. But as I say, it's not the type that employs many people. I mean, we've had 500,000 more people in manufacturing employed so far in this recovery. That's the good news. But over the last 20 years, we've lost 7.5 million. I mean, we're a long way from any decent recovery, and I think that's the way it's going to be from here on out. Because, even though wages in China are rising, and many people point out that their minimum wage in many cities there is going up 25% over the last year. Okay, fine, but what happens to the low-end manufacturing? Well, it leaves China, it goes to Bangladesh or Pakistan or Vietnam. I mean, we're still getting these low labor cost products coming into this country. China's moving up the scale of sophistication. They want to get more income there to get more domestic-driven economy, but it doesn't mean that we don't have competition from China. We just have it from moving to other lower-cost countries.
Gary, I want to shift gears just a second because there's been a lot of discussion of late as to the Federal Reserve's policy beginning to taper the easing they've been engaging in. What's your take on what Fed policy is going to be moving ahead?
Boy, this is like Mark Twain said about New England weather. If you don't like it, wait a minute. It's going to change. There's a different interpretation every day, but the Federal Reserve, if you look at the fundamentals, the Federal Reserve has built up a huge balance sheet. When they buy securities and those payments are made, they end up in the reserve accounts of the member banks. In other words, they buy a treasury from you. You deposit a check in your bank, and that ends up in that reserve. Now, normally the banks lend and relend those reserves, but they haven't been doing that. So they've got this pile of excess reserves. The difference between the required and the total reserves is $2.1 trillion. Now, that doesn't make any difference now, but when this age of deleveraging is over in another 5 years or so, and it normally takes a decade, we're halfway through it, and we resume much faster growth, then you'll see that money lent out, and it potentially could be very inflationary. So the Fed has to deal with that. They got to get rid of those excess reserves. But in the meanwhile, they've got to stop adding to them. And that's what they've been doing recently. They're buying $85 billion in securities every month, and those securities just add another $85 billion to excess reserves. So the first thing they got to do is stop adding to the pile, and then they got to reduce the pile. Well, just the mere suggestion that they were going to stop adding as much month by month to the pile, tapering it's called, buying less and less in these $85 billion a month, cutting it back in the future, that really threw the markets into a cocked hat back in May and June, because people have been so reliant on the Fed, particularly equity buyers, that that's all they really care about. They're not paying attention to the economies on the ground, which are limping along at best. So you have a situation here where the Fed is, they've got a tiger by the tail. They know they've got to get out of this problem sooner or later, but they don't know how. I mean, right now, as we speak, in St. Petersburg, this G7 meeting, 20 largest economies in the world, the Chinese and everybody else is clamoring on the U.S. Not to taper too fast, because what's happening? The mere suggestion that the Fed was going to taper has led to an outflow of money from the developing countries. Earlier it was rushing in, now it's rushing out, and that's very disruptive to the likes of Brazil and Indonesia and many other developing countries. So it's a very difficult problem that the Fed faces, and I think that they are probably going to move towards some kind of tapering, and by now I think it's pretty well, some of it's already anticipated by markets, but they're trying to tread very lightly and tell everybody what they're trying to do. I think they're being even too transparent. There's no mystery left, but in any event, they do have a considerable problem. It's the next chairman who's going to have to deal with it. Bernanke's leaving in January, by all reports.
Well, last question, Gary. What are you advising clients presently as far as investing is concerned?
I think you have to be very, very cautious, because the whole question is, are we in a risk-on environment or risk-off? Risk-on is when people are interested in stocks, they're interested in commodities. They don't like the safe haven of the dollar or treasury bonds. And risk off is completely the opposite. People stay away from stocks. They stay away from commodities. They want the safe havens of the dollar and treasuries. And we're switching back and forth between the two at an amazing speed. And it's very difficult to thread your way through this. And I think that one has to be very, very cautious right now. There's been somehow the hope that the Fed is going to work out of this excess reserves without killing the goose. But then treasuries have been selling off, and higher interest rates are not very good atmosphere for stocks. So my advice is for anybody, unless you're a day trader, is you want to be very cautious and hold an unusually large portion of cash. At least it doesn't go down in value.
Well, terrific, Gary. Thanks for being with us today. Our guest today has been Dr. A. Gary Shilling. The website is agaryshilling.com. Always a pleasure to have you on the program. Thanks for being with us.
I'm glad to be of help. Thanks for having me.
Everything Financial Radio will return after these words.